Fundamental analysis. In this session, we are discussing certain fundamental factors which are affecting the stock market. This presentation is divided into three parts. The first part contains economy analysis, in which we analyze certain economic factors which are affecting the stock prices. In the second part, we are discussing the industry aspects, industrial factors which are affecting the stock market. In the third part, we are analyzing micro factors that are company specific, which contains the performance of the company, competitions, all those things. So we'll start our first part with the economy analysis. Objectives of the whole presentation is importance of fundamental analysis in stock market operation, the fundamental factors that affecting the company's earnings, macro and micro variables which are having impact on the corporate performance, then various dimensions of industry analysis and various dimensions in investment, then learning the techniques of analyzing a company for investment purposes, finally grasping the use of fundamental analysis along with technical analysis. Now let us see what are the fundamental analysis aspect. The movement of price of securities are based on various factors relating to the economy, industry and the company. The stock prices move according to the information received at various point of time. The market receive information about the progress of the economy, the progress of the industry, then the progress of the company. The same way, the market also receive when the economic progress is retarding, or if the economic progress is not as per the expected level. Similarly, if the industry is not performing according to the expectation, and as regards the company, when the company is making losses instead of profits. The general economic condition of a country can have great impact on the stock prices. We will see what are the general economic conditions that affect the stock market operation. So the factors which are affecting the economy or the stock prices can be classified into macroeconomic factors and microeconomic factors. The macroeconomic factors are economy specific, which is applicable to all the participants in the market, and the company has no control over these factors. Whereas microeconomic factors are company specific. The company can very well control or can have some hold on the microeconomic factors. What are the economic factors that are affecting a country's performance? One important economic factor is the gross domestic product or GDP. GDP growth affects the economy as well as the stock market operations, stock prices, positively or negatively. GDP growth indicates the growth of the economy. GDP consists of consumer spending, investments, then government spending, etc. Then trade deficit, etc. Growth of GDP indicates that the economy is having high level of activity and the GDP is in a the total countries, the economy is in a progressive track. Whereas if the GDP declines, it shows that the level of economic activities in a country are at a slow pace, and the flow of investment will be low. That will affect the security market operation. Naturally, the stock prices will fall down. So when the economy is growing and the GDP shows a growth, then more investment will come into the market, and more investment will come into the market will create more demand for securities, and thereby the security prices will go up, and the total market will have a bullish tendency. And when the GDP shows a slower growth, it is an indication that the market is in a bearish trend, and economy is performing very poor. Then come the industrial production. Industrial production is an indicator of the overall corporate performance. So when the industrial production is on a very high side, then it indicates that corporates are making high profits. So when the corporate entities are making higher profits, their performance will be on a higher side, and that will attract more investment, because all the investors will be interested in investing in those shares of those companies which are making good profit, because only if the company is having good profit, they will give dividend, they will give bonus shares, they will give other benefits. So the investors look at their investment growing as the company grows. So industrial production is another important factor. Industrial production is represented by the index of industrial production, that is IIP. This is being announced periodically by the government of India. So when the IIP number is above the expected level, the market will move positively, and if the IIP number is on the negative side, market will move on the negative side. Then the infrastructure facilities. When there are proper infrastructure facilities like road, bridges, and all those things, the country will have economic progress. Whereas when the infrastructure country is having poor infrastructure facilities, it shows that country is on a lower growth level, which will not attract investment, because every investor will be interested in investing in countries on the progressive path. So when the infrastructural facilities are very low, there will be poor investment, so the security price will be affected, demand for securities will be low, and the security prices will be affected. Naturally, the stock prices will fall down. Then the agricultural production. The agricultural production contributes substantially to the growth of an economy. When a country is having surplus of agricultural production, it can feed the masses by its own. Whereas when the country is having a deficit, it cannot. It have to look at other countries, or it may have to get assistance from other countries. So when the country is having a surplus production, it can feed not only its masses, but it can also provide food to the neighboring countries. So when the surplus food, the agricultural products are exported to other countries, the country will be earning foreign exchange. Similarly, when we are short of food, agricultural commodities, we may have to import it from other countries. That will be costly, because we will lose our valuable foreign exchange, and that will lead to a balance of payment crisis. Then monsoon and agricultural production is money supply is another factor. Money supply is an indicator of an economy's strength. As the money supply increases, the inflation also goes up. So the aggregate money supply is represented by M1 plus M3, M2 plus M3 plus M4 And M1 is known as the narrow money, which consists of currency with the public and demand deposit with the banks. M2 is the sum total of M1 plus post office savings bank deposit. M3 is the broad money, which comprises of M2 plus time deposit with the banks. Broadly speaking, M3 covers the net bank credit to the government by RBI, bank credit to commercial sector, net foreign exchange assets of banking sector, government government's currency liabilities to the public and banking sectors, net non-monetary liability, etc. Now M4 is M3 plus total post office deposit. So this is the general structure of money supply in a country. And when money supply increases, Reserve Bank enter in the market, and they either you might have heard about increasing the reserve ratio, cash reserve ratio, and the statutory liquid ratio, or reducing the statutory ratios. Similarly, changing the policy rates like repo and reverse repo. Recently it happened. So when the Reserve Bank changes the policy rates or the reserve ratios, generally the money supply is affected. When the Reserve Bank increases the policy rates and the repo and no, the reserve ratios, naturally the money available with the banking system will come to a lower level, and the interest rate will go up. Naturally there will be a control over the money supply. People will be reluctant to take loan. So thus in that manner, Reserve Bank hopes that it can control the money supply and reduce the money which the people are holding. When people do not have money, they will not purchase. So when the demand will come side, so when the demand come to the lower side, generally it will pull down the price at the lower level, price to the lower level. So that will reduce the will result into reduction of the inflation. Whereas when the money supply increases, when the policy rates or the the statutory ratios are reduced, more money is pumped into the system, because the banks need not keep the higher rate of reserve assets, so they can use that money for lending purpose. So naturally supply of money increases. When the supply money of increases, then the interest rate comes down, again the inflation is coming down. So naturally there will be more investment opportunities. So when the inflation is low, people will be interested to invest in such countries. So the investment will increase. So the demand for the shares will increase. So the market will have a bullish tendency. More demand for shares will be created. So people will buy more shares, and that way the market will boom. Whereas when the money supply is reduced, naturally when the inflation rate increases, money supply increases mean when inflation increases, then naturally the money disposable with the people will be low. So it will affect the investments. So investment will come down. So demand for the investment will come down. Naturally the prices will fall. So the security price will fall. So you will see the market on a bearish moment. Now come the inflation. As we have already found, inflation is the difference between the wholesale price indices at two given point of time. So inflation can be broadly defined as the rise in price level. Now inflation is measured by the movement of price indices. So generally in India we use is the wholesale price index, whereas some countries are using consumer price index. Say the inflation will definitely affect the stock market prices, as we have already stated in the previous point. The inflation will reduce the money disposable at the hand of people, so they will reduce their investment. So demand for the securities will be less. It will pull down the prices, and the market will fall down. Whereas when the inflation reduces, then more money will be available with the people for investment. So they will buy more shares, that will increase the demand for shares. Naturally, the price of the shares will increase, and market will have a upward movement. Then comes the savings and investments. When a country's savings and investment savings rate goes up, then the potential for increase in investment also goes up, because the people will be having more surplus with them for investment. Now, countries having low domestic savings depend on overseas investment by attracting FDI or FII inflows. So, the domestic savings and investment rate plays pivotal role in uh, the economic progress of a country, and thereby the movement of stock prices. Then then come the unemployment. When there is a high rate of unemployment, then the people will not have enough money to at their disposal, because they don't have any employment, so there is no income. As such, they will find it very difficult to spend money for find out money for investment purposes. This will reduce the demand for the securities, and naturally uh, the stock prices will fall down. Whereas when the unemployment rate reduces, um, generally the stock market moves up, because the people will have more money with them, because they have employment, enough income, so they will have surpluses, so they can invest in the stock market. Then we have the demographic factors like population growth, sex ratio, age, occupation, literacy, etc. So these factors changes periodically. Now the census is taking place only once in 10 years. So by the time a substantial change might have taken place in these factors. So demographic factors are essential for forecasting demand for consumer products. So besides these factors also give us information relating the availability of labor. So we can forecast the labor availability at different points of time using demographic factors. So, and India is a labor intensive country, hence availability of sufficient labor is essential for improving the production. So when the demographic factors are not so can also influence the stock market prices. Then come the balance of payment position. A balance of payment position shows an obligation of the country to the external world. So, see, a growing obligation to the external world will lead to deficit of balance of payment position. Consequently, such countries will resort to enhance the external borrowing, and finally, they may lead to an eventual debt trap, just like what happened in the case of Greece, Portugal, Italy, etc. Then, so this will ultimately what happen? They will have to be assisted by other countries, and they will again be borrowing at higher cost. So a deficit BJP indicates a weak economy, and no one will invest in such economy. So they will not have enough investments. So their security prices will fall down. The whole market will crash. That is what happened in the we are seeing happening in the market for the last about 1 year, because of the Greece, Portugal, Italy issues. The whole markets are falling down. So when the no, balance of payment is in deficit position, the whole economy will be affected, investment will be affected, and naturally market prices also will be affected. Then we have the current account. So current account is a part of the balance of payment. It indicates that the sum total of trade transaction and invisibles. The trade transactions are export minus import. Invisibles are other payments like dividend, then interest, etc. Now, when current account is in surplus, it shows the health of the economy. Whereas when the current account is in deficit, it shows the economy is weak, and they will have to depend upon other country for their financial assistance. So a deficit current account shows that the domestic capital formation is slow, and therefore they have to depend on excessively on external borrowings. So when the external borrowings are on a higher side, it will lead to the country to a possible debt trap. So the current account deficit is an important factor which affects the investment in a country, and thereby it affects the stock market prices also. Then come the exchange rate. The one of the major objective of the government is to ensure stability in exchange rate. When the exchange rate fluctuates uh, very frequently, it shows the economy is not performing very well. Then when the exchange rates when the exchange rate shows whether the country's currency is weak or strong. When the country's currency is weak, then definitely the overseas investors will not come and invest in this country, because they may have to bring uh, they, uh, they may have to bring more foreign currency, whereas when their investments are withdrawn, they get only lesser foreign currency amount, so they will not take such risk. So exchange rate fluctuation affects the stock market prices. Then economic reforms. When a country is in progress, so many economic reforms come into the government may have to come out with so many economic reforms. Now when the economic reform happens, it changes the trend of the economy, so it can be good or bad. So the macroeconomic factors changes, fundamental changes as the implementation of economic reforms in progress. So these economic reform programs also are having some influence on the stock market prices. Then come the government policies. The government periodically announces their policies, say industrial policy, business policy, then budgetary announcement, legal policies, and labor policy, etc., etc. So these all these are affecting the production and the supply side. So the or demand side. So the government policies also affect the stock market prices. So this is the figure showing India's GDP growth over a period of 5 years, and this is the industrial index of industrial production, April to November. This is the inflation, India's inflation from 2005 to 2010. You can see that inflation is seen increasing. Now the government policies, industrial policy. Under the government policy, we have industrial policy. So government periodically announces industrial policy. Based on that, various the industries get certain concessions or certain liberalization. So it will affect the whole units working in the industry also. So it will affect the corporate performance. So people will be more interested in investing in such industries. So the industry policy will have some impact on the stock market prices. Then come the budget and management of budget deficit. Now we already found that budget deficit is something very crucial, very significant in the stock market operation. The government presents the budget every year, and the budget can show surplus or deficit. When the income is higher than the expenditure, it is a surplus revenue. It generates revenue surplus, whereas when the income is lower than the expenditure, it is a revenue deficit. It is all then come the budget deficit. When the budgeted expenditure is higher than the budgeted um, income, it is the budget deficit. Now the growing budget deficit is a concern of about the country, and because it will create inflation. So the generally countries do not encourage the budget deficit growing, so they will curtail subsidies, they will curtail expenditure in order to etc., in order to stop the further deterioration of the budget deficit. So every time the government's objective may be to abolish the budget deficit or reduce budget deficit. So the budget deficit also, when the budget deficit is more, either the government may have to print currencies, or they may have to borrow from the banking system, central bank, or from the general public. So budget deficit is also another important thing, because when the deficit is more, the country shows a weak position. so which will reduce the attraction of which will have reduced flow of investments, so that will ultimately uh, pull down the prices in the market and vice versa. Then fiscal policies. Government announces fiscal policies relating to the income, expenditure management, etc. In order to so they will also address some taxation policy like tax collection, etc. So these will have impact on the corporate performance, as the as higher taxation or some other policy measures may affect their total expenditure or income. So similarly, the government expenditure is also another important thing. When the government curbs the expenditure, it reduces the money supply to the market. So naturally, um, uh, the stock prices also may come down because of poor performance of the economy. Then come the monetary policy. Reserve Bank announces monetary policy every half year, and at that time they will review the whole economy, and they sometimes increases the policy rate or reduce the policy rate, or they increase the bank rate, or they reduces the bank rate. All those things, it happens during this policy monetary policy announcement. So this is also having great impact on the stock market, because when the money supply, we have already seen that when money supply increases, people will have more money at their disposal, and they will come and invest in the market. So it will increase the supply, reduce the supply of shares, whereas increase the demand for shares, so market will increase. Then come the supply side policies. uh, Supply side policies give more attention to the taxation aspects. While demand side policies use taxes to reduce the consumption, demand and consumption demand, whereas supply side policies focus on giving incentives through tax concessions, so that the production will be more. So those who favor supply side policies argue that lower tax rates will promote more investments and will act as an incentive to work more, leading to higher economic growth. So the supply side policies also affect the stock market operation. Then come the legal policies. The government come out with the various legal enactment, and they bring various type of laws, or by amending existing laws, or by introducing fresh laws. So this will have positive or negative impact on the stock market, because when the legal policies are not conducive to the economic and corporate growth, then it will affect their profitability, and ultimately people will either withdraw their investment from such areas, or they will not come with fresh investment. Again, the market will fall down. Then come the labor policies. The labor is another important factor. When the labor policies are amended, and when the say employees are given more benefits, so actually what happens then, the corporate expenditure increases, and it will affect the profitability. Then it will in turn affect the price of the shares in the market. Then the regulatory interventions. So often Reserve Bank Reserve Bank or government will see interfere in the market with say certain activities. So that is only for regulating the market, but that will affect the stock prices, because it will either pull down the demand or push up the demand. Then the tax regime. Tax is an important thing. Every country is having tax system, and the tax regime in a country can be favorable or adverse to the industries. If the tax regime is adverse to the industry, it will affect the industry's progress, because they may have to higher rate of taxes that will reduce the profit at disposal, profitability, and the profit which can distribute among the shareholders. So naturally, people will be reluctant to invest in such companies. So the stock prices will fall down, and vice versa. Then come the international relations. So international relations also contribute economic development. So a country which does not maintain good relation with the neighbors will have low capital inflow, so that will affect the country's progress. So the good international relationship enhances investment from abroad, so that will boost the whole economy. So international relation is also having some link with the or some influence on the um, stock prices. Okay. Then political philosophy. When the political philosophy ideologies of parties in a coalition government may differ, coalition government differs, then some adjustments may become necessary, and sometimes the administrative decisions may get delayed. So sometimes policies may have to be rewritten. So it will generally when it is when the country is governed by more than one party as a coalition, then there will be a lot of political adjustments might become necessary. So these things, the political philosophy of country will affect the stock market, because all these policies affect the demand or supply side of the stock market, and that will affect the price movement. Then come the disaster management. When the country, the whole area or where the company is situated, or even the company itself, some hazardous process is going on, and some explosion or some type of problem happen, means it will take years or more time and more investment for rebuilding the premises. Similarly, such thing happen in the locality also. This takes place. So disaster management is another important thing which affect the stock prices. Say when the earthquake happened in Japan, the stock prices flashed down. Then come the social and cultural environment. Some of the social and cultural position of the country, or cultural behavior of the people in a country affect the stock market operation. So if the company is acting against the sentiment of the society, the people will strongly oppose, and sometimes the company may have to close down. So the investors will lose the money. So it is important that before we invest in the company's shares, understand what is the social and cultural environment in which the company is situated, how far they are committed to the society. Now come the business cycle. Every business has a period of boom and depression. So boom period shows progress, and whereas depression shows regression. Now during boom period, the economy expands, and the production will be more, employment will be more income will be there. So people will be very happy. Whereas in the case of depression, the economy contracts, and there will be no money with the people, and the government will also find very difficult to find money for investment, infrastructure, facilities. So the economy contracts during the depression. Then transition across cycles are called peaks and troughs. When the economy moves from one state to the another state, there can be a trough and peaks. Peak denotes the end of the boom, and trough denotes the bottom level of recession. So when the business cycle is the peak level, it shows that the boom ended, and it is now going to fall down. And when it reaches trough, it denotes that the recession is over and it is now going to take off. Expansion recession process affects performance of industry. So all these are ultimately affecting the industry and the firm. Now, the leading economic indicators are those economic indicators that rise or fall ahead of the economy. Then lagging economic indicators move in tandem with somewhat or after the broad economy. Leading economy indicators are those economic indicators that rise or fall ahead of the economy, and lagging economic indicators somewhat move in tandem with or after the broad economy. Then a wide range of economic indicators are released to the public regularly by the government by publishing the economic calendar. See, we have given sample of the economic calendar here. So you can find that what all things happening every month and in a year what will happen. So this is a copy of the 2007-8 economic calendar, where you can see the 4 months period, and during the period what all things will happen. And you can see August, October, also August, October, then November, December, January, February. 6 months activities are given in this particular chart. This is the economic, known as economic calendar. So you can find that the production index. So these index, the announcement will come on the dates there. See, national accounts, the policy, price index, consumer price, consumer. So the price index will be announced on these particular dates. So similarly, consumer price also, wholesale price also. Okay. Then economic forecasting means the stock prices are sensitive to events that adversely affect the economic fundamentals. So it is based on this we forecast what is going to happen in the nearby future. Then when somebody knows that such event is going to happen, then the forecasting will become more accurate. The various techniques are used for long term and short term forecasting. Now so these type of techniques are statistical techniques are for used for developing a proper model is known as the econometric model. So econometrics model applies mathematical and statistical techniques to economic theory. So the economic theory is actually applied using the mathematical and statistical technique in the econometrics. Econometric model building involves the specification of a system of simultaneous equations consisting of endogenous and exogenous variables. Endogenous variables are within the firm, and exogenous variables are outside the firm. Then some of the well-known econometric models are FRB, MIT, Carlos Rabank, Institute of Technology model, Michigan model, Pennsylvania model, and Boston model, etc., etc., etc. So with this we close the first part of our presentation, and we will take a small break, and we will come again for the next part, the second part.